Welcome to this month's Market Matters monthly video update. I'm Matt Snodgrass and I'm joined here by lead portfolio manager James Gerrish.
Great to be here, Matt, to start off a new year, 2025.
First of the year. In this video, we're going to discuss the calendar year 2024 Market Matters suite of portfolios and their performance, and then we'll touch on how we're positioned moving forward. James, Active Growth Strategy, it's our flagship fund. How do we perform in calendar year 2024?
Yeah, so I'll just set the backdrop a little bit initially, Matt, just in terms of how markets performed in 2024, because it was a really, it's a hard way to describe the year, but the performance of the market was really underpinned by a few certain sectors. So the ASX 200 inclusive of dividends put on 11.4% for calendar year 2024. So a good return in isolation, but then when you compare that to other markets around the globe. So US stocks had a phenomenal year. They were up 25%. But then if you cast your mind over to emerging markets, Chinese equities, etc., they had a really challenging year. So we were somewhere in between. And if you look at the Dow Jones Industrial average, which is more, I guess, aligned with the composition of our market, it did something like 14%. So overall, it was a really strong year in some parts of the market, a really tough year in other parts of the market, and our active growth portfolio reflected that. In breaking out the composition of the index returns here in Australia, 7.5% of the 11.4% done by the index was attributed to the major banks. So they had a phenomenal year. And if you were underweight the banks, as we were, then that was a real hindrance to performance. And then you counter that with what the materials sector did. The materials and energy sectors were the two weakest here in Australia. They were down 13% apiece, and they'd attracted about 4.5% from index returns. So unfortunately, in the active growth portfolio, we were underweight the banks and we were overweight the materials and energy space. We had about a 10% active weight towards the materials space and energy space combined. So when I talk about active weights, that's active over and above the benchmark weighting. So that was a hindrance to performance in calendar year 2024. We obviously came off the back of a really strong calendar year 23, and we've also got obviously 6 months to go for the financial year 25. So a tough year from a performance perspective in the active growth portfolio. And that's dragged our longer term numbers. So if I look at the last month in December, markets were weaker in December. So the Aussie market pulled back 3%. Our portfolio was down about 4%, the active growth portfolio, so underperformance there. On a 1 year view, we're up just shy of 4%, whereas the benchmark's up nearly 11.5%. So clearly underperformance there. And it's really disappointing to sit here and talk about underperformance. And it's dragged down our longer term numbers. So in terms of our 2 year numbers, our 3 year numbers, and the inception numbers, they're still well above benchmark. So inception to date on that portfolio is 12.8% per annum, which is about 3.5% above the benchmark. So we're still really comfortable with a long term strategy. The shorter term performance has been quite frustrating. What I would say though is that, and I speak to clients about this quite a lot around allocating capital. So allocating capital into managers that have had a tough short-term period, but then longer-term numbers stack up is what you want to be doing. Not chasing performance. So not managers that have got a struggle in the longer term, but have had a really short-term bump in performance. So I'd leave you with that message. In terms of how that portfolio is positioned, we've retained our overweight position in materials and energy. I think that's really going to bear fruit in 2025. I say that, and we've already had, the first couple of weeks. We're recording this on the 15th of January. The first couple of weeks of this calendar year have seen that reversion start to play out. So the materials space is up circa 3%. The energy space is up 5.5%, whereas the IT space is down 3%. So we're starting to see some of that performance reversion play out, and that's what we're still backing here. So remain patient in that portfolio. We're well aware of the short-term underperformance. Focus on the long-term numbers remain solid. And it's quite extraordinary we can have such a period of underperformance, yet those 2, 3 and inception numbers are still stacking up in the active growth portfolio. So stay the course in that one is my message for the active growth portfolio, Matt.
Yeah, okay. You touched on there at the start, in a macro backdrop perspective, how strong US markets were outperforming the rest of the world. How did the international equities portfolio go in that regard?
Yeah, it was quite phenomenal. So there's the amount of money that's now flowing into US equities, whether that's obviously they've had some tailwinds before Trump won the presidency, but that's just I guess fueled the fire even further. So we've got really pro-growth policies about to be enacted over in the US. Tax cuts, deregulation, tariffs are going to counter that. To some degree, but they will be supportive of what plays out in terms of US earnings for US dominated companies. So that portfolio had a strong year. It was up north of 20%. And in terms of the 3-year numbers, it's up 15% for 3 years, and it's up just shy of 20% per annum since inception. So that portfolio has been around since 2019. So we're starting to get some meaningful track record in the international equities portfolio. So again, I was comfortable with how that portfolio was positioned. Obviously, technology was a big driver of those gains. It's not a tech-centric portfolio. It holds technology, but it's broader than that. So there are commodity names in there. There are financials in that portfolio which performed well, and there are other interesting companies in the consumer space that we own. So I like that portfolio, and I think I've encouraged over for a lot of years now for the portfolios that we manage for our wholesale clients to really embrace international investing. So the Australian market is such a small component of the global equity market that international investing is really important. Obviously, there's been a pretty positive tailwind from a weakening Aussie dollar as well. So that's helped those returns when you bring it back to Aussie dollar terms. But the positions in that portfolio, the companies in that portfolio have continued to do well. As I think about 2025, I think about harvesting some of the gains out of those high-performing positions, the ones that have performed really strongly in that portfolio. Apple comes to mind. That's one of our positions that we've had for quite a long time. It's up nearly 400% in that portfolio. But you think about the growth going forward in that company, and I think it's going to struggle to grow in the years ahead. So that's one of the decisions we're thinking about now on the desk around how to optimize the portfolios for 2025.
Mm-hmm. Moving on to a newer portfolio, the core ETF portfolio does have an allocation to US stocks in there, but more of a diversified approach. Can you chat to us on the asset allocation of that portfolio and how you're positioned there, and how that translated to performance for calendar year 24?
Yeah, this is a new portfolio. So when we talk about new portfolios, it was initiated on the 21st of April 2023. So obviously it's now got over 12 months track record, but I still call that new. I think performance has built over multiple years, not on a month-by-month basis, and I think that's the way investors should be looking at it. In terms of that portfolio for the month, it was down 0.9% again against the backdrop of the ASX, which was down 3%, and on a 12-month view, it was up about 13%. So it's got a cash plus 3% benchmark. So it's got an absolute return benchmark. As you alluded to, the asset allocation is split between Aussie equities, international equities, fixed income, infrastructure, property. It's got a cash allocation in there, hybrids and the like. So it is your typical diversified portfolio. I know there's a lot of negative rhetoric around the old 60-40 portfolio, and it's not a 60-40 portfolio, but it does have that structure around 60% into growth-focused assets and 40% into more defensive style assets. So it's done really well since its inception date. It's a lower activity portfolio. It's more of a passive approach, but we do realign it from an asset allocation perspective. So we've got asset allocation ranges that we stay within, but we do upweight and downweight certain particular asset classes within the portfolio. So core ETF portfolio going well, Matt, in 2024, and I expect it to continue in 25.
All right, and now small caps. They had a better year last year, calendar year 2024, returning roughly 8%, versus large cap peers of 11%, so slightly lagging there. Still a better year than calendar year 23, though. So can you talk to that and the emerging companies portfolio and how that performed?
Yeah, there's a bit of money coming back in the small caps. There was more so before the December quarter. So the December quarter saw some outflows from the smaller companies here in Australia, and that hurt performance for the the annual performance for the Small Ords Index. One of the key trends that have played out, I guess, sort of in the first 3 quarters of calendar 2024 that helped that part of the market was what played out in bond yields, so interest rates. So we had, in September in 2024, we had US 10-year yields around 3.6%. From September up into December, or where they are now, we're sitting at about 4.8%. So there's been a big recalibration in interest rates, and that has a bigger influence on small cap stocks because they require financing for growth, and the cost of capital is more important. It's important across all asset classes, but it's really important in terms of small caps. The emerging companies portfolio had a tough December. It was down 4%. The index was down about 3%. Inception to date, it's up about 4.46%, very marginally above its index. So this has continued to be a bit of a struggle for the Market Matters emerging companies portfolio. What I would say is things turn quickly in the small company space. We've continued to do the work on the positions that we own. We're comfortable with the lion's share of portfolio positions at the moment. And we're looking for a better 2025 in terms of returns for that after what can only be characterised in 2024 as an underwhelming result, Matt.
Alrighty, and finally, last but not least, an income-focused portfolio, Aussie multi-asset. How did the active income portfolio go over the period?
Yeah, I like this portfolio. So for those out there who are looking for quite a defensive focused portfolio that has a lot lower volatility, I think standard deviation in this portfolio is about 7%. Had a maximum drawdown in 2024 of about 4%. So the risk metrics of this portfolio really stack up. If I look at what it did in December, it was up 0.2%, slightly below its RBA cash plus 4% hurdle rate. But again, that was in a soft market. And if I look at on a 12-month view, it's up around 7%, and the inception to date is up 8.4% per annum, which is about 3% ahead of its benchmark. So when you're thinking about returns, you've always got to anchor it to the risk that you're taking to get them. So it's an equity portfolio. It has some fixed income securities in there, property and hybrid securities. There's obviously been some news out in 2024 around hybrids, and they will be being phased out from 2027 onwards. So there'll be some work to do around reallocating that capital within this portfolio, but we've only got maturities starting in 2026 and progressively out to 2032 from there. So strong performance. It's doing what it says on the tin, which is being defensive, being low volatility, providing a good level of income. It's forecast to yield around 6% in the next 12 months. So that's a portfolio that would really suit income investors out there.
Great. Now, looking forward, we don't like to make bold predictions. It's always a challenge to make those predictions for the year ahead. How do we see markets playing out over 2025, James?
Look, we have views on markets and we write about them every day. That's what our subscribers expect us to do. So in terms of 2025, I think that the key message, and without preempting what we're going to cover in our reports as they commence on the 20th of January once again, we think it's a year where the trends that played out in 2024 will mean revert. So momentum, I look at factors in the market. So what's driving returns in the market? And the momentum factor was the key driver of returns in 2024. So by that, I mean, you'll have great returns out of funds that are momentum-based funds. So whether that's momentum in price, momentum in earnings, etc., and they're not anchored to valuation. I think valuation was one of the forgotten principles in 2024. I think that will come home to roost in 2025. So, we're focusing on the areas of the market that didn't do so well in 2024. I know they weighed down our portfolio, well aware of that. But I think, again, just stressing the importance of not chasing those things that have done particularly well in the prior year, thinking they're going to naturally do well in the year coming. I think valuations will be really important. I think we're going to muddle through from an economic standpoint. The US is going to have some more favourable economic tailwinds in 2025. I think locally we're going to start cutting interest rates, and I think in this upcoming February reporting season we'll get a real good handle on how companies have these efficiency programs that they all spoke about last reporting season, the one before and the one before that, the cost cutting that they've put through their businesses, whether or not that's actually bearing fruit. And we've seen a couple of early indications this year so far of companies in different sectors that are actually doing that. So whether or not these efficiencies will drive earnings growth from an aggregate index level in 2025, it's probably going to be a tough year because commodity prices are still relatively low, but the market is pricing these commodity companies at such a low level. There's not a lot baked in. So I think more positive rhetoric coming out of the materials space, that's going to be predicated on what plays out in China. I think it's forgotten in the last quarter of 2024. China is obviously continuing to signal strong stimulus measures. We still think that's a game changer. I know that's been the wrong call in the last quarter of 2024, but we still think that's in play, and we don't want to be void of our positions towards that into 2025. So, we're just going to continue to hold our convictions. We're going to continue to do our work on a daily basis, write to our members around our views, and I think all stacks up. Things look pretty solid for markets in 2025. I don't foreshadow something materially negative happening in markets, but by definition, the things that really hurt markets are the things you don't think about. So eyes up footy, as I often say, on a daily basis. We'll manage our portfolios accordingly, and that's how we'll approach 2025, Matt.
That's a wrap. Thanks for tuning in to the Market Matters monthly video update, and all the best for 2025.